$50,000. Same 5 funds. 2 completely different outcomes. Build it one way, and that money pays you over $1,500 a month for the rest of your life. Build it the exact same 5 funds a different way, and that same $50,000 grows into more than $3 million. Same starting amount, same 5 funds. The only thing that changes is how you weight them, and that one decision is the difference between a steady paycheck and a number with 7 figures. In this video, I'm taking $50,000 and spreading it across the 5 best Fidelity index funds. Funds built to cover everything from America's biggest companies to the fastest growing corners of the world. Then I'll show you 2 completely different ways to build a portfolio out of those same 5 funds. One tilted to pay you every month. One tilted to grow as large as possible. By the end, you'll know exactly which one fits your actual goals, and it might not be the one you expect. Quick thing before we get into the funds, in case you're newer to this. An index fund is just a basket of stocks that follows a set rule. Nobody's sitting there picking winners and losers. The fund simply owns whatever's inside the index it tracks, nothing more. That's exactly why these things cost almost nothing to hold, and why they tend to work so well if you just leave them alone for the long haul. Every solid portfolio has a handful of jobs that need filling, something to anchor it, something to grow it fast, something reaching for companies that haven't made it big yet, something paying real income, and something betting on the parts of the world everyone's already written off. 5 jobs, and the 5 funds in this video handle exactly those 5 roles. One more quick note, because we're about to use the word dividend constantly. A dividend is simply a slice of a company's profit paid back to you for owning the fund, usually every 3 months. Own more shares, get a bigger check. That's the whole idea. All right, quick disclaimer, then we get into the funds. I'm not a licensed financial advisor, and none of this is personalized advice. Think of it as me walking you through the reasoning, not handing you a guarantee. All projections in this video are estimates based on historical averages, not promises of future performance. Fund yields and growth rates change over time. Always do your own research or talk to a professional before investing. Okay, disclaimer handled. Let's build this thing. Fund number 1, FXAIX, Fidelity 500 Index Fund, the anchor. This is the one nobody debates. FXAIX tracks the S&P 500, the 500 biggest companies in America, all in one fund. When someone says the market was up today, this is basically what they mean. The names inside are exactly who you'd guess. Nvidia, Apple, Microsoft, Amazon, Meta, and it leans heavily toward tech, more than a third of the entire fund. The numbers: roughly a 1% dividend yield, dividend growth running around 7% annually, and historical annual price appreciation around 13 to 14%. That appreciation number becomes the steady benchmark everything else in this portfolio gets measured against. The expense ratio here is almost a rounding error, 0.015%, essentially free to hold. If you're building anything at all, this fund is the floor you build the rest on top of. Think about what you're actually buying with that one fund. 500 separate companies, weighted by size, updated automatically as the economy shifts. No rebalancing required on your part, no guessing which company wins next quarter. It's the closest thing to owning the American economy in a single ticker, and it's the reason nearly every serious long-term portfolio, no matter who's building it, starts in roughly the same place. Fund number 2, FNCMX, Fidelity Nasdaq Composite Index Fund. The growth engine. If FXAIX is the anchor, this one is the engine. It tracks the Nasdaq Composite, roughly 3,000 companies, heavily packed with tech. Quick context, because this trips people up. The NASDAQ isn't a company, and it isn't really a fund either. It's a stock exchange, a place where stocks get bought and sold. It just happens to be where most major tech names choose to list. So any fund tracking it tilts hard toward tech almost automatically. Some of the same names show up here, as in FXAIX, Nvidia, Apple, Microsoft, Amazon, Alphabet, but the weighting tells a completely different story. Here, Nvidia alone can be more than 10% of the fund, and the top 10 holdings combined make up close to 60% of the entire thing. You're not getting 3,000 companies spread evenly, you're getting a concentrated bet on a handful of tech giants with a long tail trailing behind. The dividend yield sits under 1%, but the annual price appreciation historically runs close to 18%, the highest of any fund in this lineup. That's the upside case. The trade-off. That same tech concentration cuts both ways. When big tech runs, this fund flies. When big tech stumbles, this is the fund that feels it first and feels it hardest. Think of it this way. FXAIX gives you the whole orchestra. FNCMX hands the microphone almost entirely to the lead guitarist. When that guitarist is having a great night, the whole show feels electric. When they're off, there's nobody else carrying the tune quite as hard. Fund number 3, FSSNX, Fidelity Small Cap Index Fund, the wild card. FXAIX and FNCMX have one thing in common. They're both built from giants, companies that already made it. That leaves an obvious gap. Where's the growth that hasn't happened yet? VOS SNX tracks the Russell 2000, about 2,000 small American companies, the ones too small to crack the S&P 500. Some of the top holdings here are names you've genuinely never heard of, and that's kind of the whole point. Unlike FNSEMX, nothing in here is a concentrated bet. The top 10 holdings combined add up to under 6% of the fund. It's 2,000 small shots on goal, spread thin. The logic is simple. Every giant sitting inside FXAX was a tiny company once too. This fund is a bet that a few of today's unknowns become tomorrow's household names. Here's the honest part though. The numbers don't tell the story you'd expect. Small caps are supposed to be the high-risk, high-reward slice, the rocket fuel of a portfolio. But historical annual appreciation here actually runs lower than both of the big U.S. funds, closer to 9 or 10%. Small caps have genuinely trailed the giants for years. So why hold it at all? Not because the track record wins. It doesn't. You hold it because it's the one corner none of the other funds can reach. The small stuff before it gets big. Not a sure thing, a deliberate bet. There's also a quieter reason this piece matters over a full career of investing. Small cap cycles don't move in lockstep with large cap cycles. There are entire multi-year stretches in market history where small companies genuinely outran the giants, just not recently. Holding a slice here isn't about chasing last decade's winner. It's about not being completely absent the next time leadership rotates. Fund number 4, FSPSX, Fidelity International Index Fund, the income and insurance play. Every fund so far is 100% American. And here's the problem with stopping there. Every dollar is riding on a single country, and no country leads forever. The U.S. has had brutal decades before, going nowhere for years while the rest of the world kept moving. Putting a piece of your money outside America isn't betting against it. It's making sure your entire plan doesn't depend on one country winning every single decade. FSPSX tracks the MSCI EAFE. Developed countries outside the U.S. think Japan, the U.K., Germany, Switzerland, Australia, established economies, stable large companies. Names like Nestle, Roche, AstraZeneca, HSBC, and ASML, a Dutch company most people have never heard of that builds the machines advanced enough to actually print a modern computer chip. They don't make the chips. They make the machine that makes the chips possible. This fund pulls double duty, income and insurance. Here's where it earns its spot. A dividend yield historically around 5 to 6%, more than triple the next highest fund on this list. But sit with that for a second, because it pulls in two directions at once. FSPSX pays the most of any fund here, while historically growing the slowest, with annual appreciation closer to 7%. Developed International has lagged the U.S. for well over a decade. Best income, weakest growth, same fund. Hold that thought. It's the exact tension the rest of this video runs on. It's worth being honest about why that gap exists. A lot of these established international economies simply return more of their profits directly to shareholders instead of plowing everything back into growth the way American tech companies tend to. That's not a flaw. It's a different philosophy of running a business, and it shows up directly in the yield. Fund number 5, FPADX, Fidelity Emerging Markets Index Fund. The long shot. Developed International hands you income and stability, but those same developed economies are the slow-growing corner of the world. That leaves one piece left, the part of the world still on its way up. FPADX is a flat-out contradiction. It's been one of the worst-performing corners of the market for roughly a decade running, and it has the fastest-growing dividend of all 5 funds in this lineup. Both are true at the same time. Emerging markets means economies still growing into their full size, not the US, not Europe, but places like Taiwan, South Korea, China, India. Roughly 80% of this fund sits in Asia, and is genuinely top-heavy. Taiwan Semiconductor, the company that actually manufactures the advanced chips the rest of the world designs, can make up over 14% of the entire fund on its own. After that, Samsung, SK Hynix, Tencent, Alibaba. Worth noticing, NVIDIA anchors the American fund. ASML shows up in the European-leaning International Fund. Taiwan Semiconductor anchors this one. Chip makers are quietly propping up every single corner of this portfolio on every continent. The reason to hold FPADX is dividend growth. Historically, the fastest growing payout of any fund here, often north of 10% annually, even while the yield itself sits modestly around 2% and appreciation trails around 7 to 8%. It's the long shot of the group, sized accordingly. That's all 5. An anchor, an engine, a wild card, an income and insurance pair, and a long shot. But here's what most people get backwards. Picking good funds is the easy part. The decision that actually changes the outcome is how much of each one you buy. These exact 5 funds can be built 2 completely different ways. Here's the income-tilted build. The biggest slice, 35% or $17,500, goes to FSPSX, the International Fund. It's the largest piece because it's the one writing the checks. 20%, $10,000, goes to FPADX, Emerging Markets, the long shot, but also the fastest growing dividend of the 5, which matters a lot in an income-focused build. Another 20%, $10,000, goes into FXAIX, the quality anchor, keeping things grounded in America's biggest companies. 15%, $7,500, goes to FNCMX, the growth engine. Even an income build needs some real growth so the account doesn't stall. And the final 10%, $5,000, goes to FSSNX, the small cap wildcard, the smallest slice, because in a portfolio built to pay you, the long shots stay small. Add up the 3 American funds, and they total 45% of the portfolio. The 2 international funds make up the other 55. This isn't turning your back on America. It's letting the higher-paying side of the world take the lead while nearly half the money stays home. Blended together, this portfolio runs roughly a 2.8% yield, a 7.75% dividend growth rate, and about a 10.35% annual appreciation rate. Here's what that's projected to do over time. After year one, $56,568. By year 10, $167,210. By year 20, $531,329. And by year 30, this portfolio is projected to reach $1,623,099. Notice how the growth accelerates in the back half rather than the front. The jump from year 1 to year 10 is real, but modest. The jump from year 20 to year 30 is enormous by comparison. That's compounding doing its quiet work in the background. The same mechanism that makes starting early matter so much more than starting with a large amount. At that point, this portfolio is projected to pay roughly $18,820 a year in dividends, about $1,568 a month for life. And critically, you don't touch the account to get it. The shares stay invested, the account keeps growing, and the dividend just shows up, quarter after quarter, powered by decades of reinvesting those payouts to buy more shares, which pay their own dividends, which buy more shares. Stretch that loop over 30 years, and it becomes a genuine snowball. Now the exact same 5 funds, weighted in the opposite direction. Half the entire portfolio, 50%, $25,000, goes into FNCMX, the growth engine, leaning as hard as possible into that historically higher appreciation rate. 25%, $12,500, goes to FXAIX, still the anchor, just a bigger one. 10%, $5,000, into FSSNX, the small cap wildcard. Another 10%, $5,000, into FABATX, emerging markets. The bet stays on the table, just size down. And FSPSX, the fund that was the star of the income build, drops all the way to 5%, $2,500. At this weight, it's not paying the bills anymore. It's just a little insurance against a rough U.S. stretch. Notice what happened. The 2 international funds go from 55% of the income build down to just 15% here. This portfolio is now roughly 85% American, and almost all of it is built to grow, not to pay. Blended together, this build runs around a 1.07% yield, a 7.35% dividend growth rate, and a much higher roughly 14.4% annual appreciation rate. Projected outcomes: Year 1, $57,756. Year 10, $206,301, already pulling ahead of the income build. Year 20, $821,468. And by year 30, this portfolio is projected to reach $3,215,547. Almost all of that growth is pure price appreciation, not dividends, which shows up exactly where you'd expect. By year 30, this version is only projected to pay around $3,561 a year in dividends. That's about $297 a month. The account that grew nearly twice as large pays you almost nothing directly. Here's the tension. The income build ends around $1.6 million, paying roughly $1,568 a month. The growth build ends around $3.2 million, paying only about $297 a month. On dividends alone, the smaller account pays over 5 times what the bigger one does. But some of you are already doing different math. The 4% rule. The idea: you can withdraw roughly 4% of your portfolio annually in retirement and reasonably expect the account to last. Apply that to the $3.2 million growth portfolio, and you get roughly $128,600 a year, about $10,700 a month. That's nearly 7 times the income portfolio's monthly payout. If pure spendable cash in retirement is the goal, the growth build using the 4% rule is genuinely hard to beat. If you'd rather play it safer, pulling 3% instead still comes out to roughly $8,000 a month. So why would anyone choose the income version at all? Because the 4% rule requires selling. That larger monthly number only exists if you're selling off a chunk of shares every single year, slowly drawing the account down. The income portfolio's payout works completely differently. Dividends get paid out while every share stays exactly where it is. You never sell a thing, and the account keeps growing regardless. That difference matters most the moment the market drops. Imagine a crash the same year you retire. With the growth portfolio, you'd be selling shares at the bottom just to cover bills, locking in losses permanently. That's called sequence of returns risk, and it's a real reason people retire with large accounts and still run into trouble. The income portfolio doesn't care what the market did this year. The checks keep coming regardless. So which one wins? Honestly, both, depending on what you actually need. The growth build makes you richer on paper and can hand you far more spendable cash as long as you're comfortable selling pieces of it and riding out market timing. The income build pays less, but never asks you to sell and never depends on good timing to work. One is a bigger pile you slowly take apart. The other is a paycheck that shows up every month while the whole pile just sits there, still growing. Put another way, the growth portfolio is a farmer who spends 30 years growing one enormous field, then has to harvest it carefully, hoping the weather cooperates on harvest day. The income portfolio is a farmer who spent those same 30 years planting fruit trees. Smaller yield each season, but the trees keep producing whether that particular year was a good one or not, and nobody has to decide when to cut anything down. That's the real decision underneath all of this, not which funds to pick, since honestly, these 5 cover nearly every base worth covering. The real decision is how you weight them, and that comes down entirely to what you actually want $50,000 to become. A bigger number you eventually take apart, or a steady check that leaves the whole thing standing. If this breakdown changed how you're thinking about building your own portfolio, let me know in the comments which build you'd actually go with. Income, growth, or something in between. I read every single comment, and it genuinely shapes what we cover next. And if you want more breakdowns like this, subscribe, because we're just getting started. One more time, because it matters. This isn't financial advice, so always do your own research or talk to a professional before you invest a single dollar.